This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week.
Welcome, everyone, to a very special edition of Street Signals. It's really hard to believe, but we are marking the 3-year anniversary of this podcast today. And honestly, I can think of no better way to commemorate this milestone than by turning the microphone around on its founder and host, my colleague Tim Graff. I'm Ramu Tyagarajan. I serve as the global head of thought leadership in State Street and work very closely with all my research colleagues across the entire State Street complex. In addition to doing the podcast, Tim runs our global macro strategy team for Europe at State Street Markets. He is a very regular contributor to the firm's publications and is a frequent media contributor. Earlier in his career, and again with the recent launch of a new product, Tim specializes in the development of relative value and macro trading strategies in currency derivatives across both developed and emerging markets. Tim, welcome to your own program.
Thank you, Ramu. It is very weird to be welcomed onto my own show, but thank you very much.
Well, we know that when State Signals was first launched, the world looked very different, Tim.
Yeah.
We were navigating the aftershocks of a pandemic, and the geopolitical landscape, while still tense, had not yet entered the regime of structural fragmentation we now take as a working assumption. Tim, you brought together an extraordinary range of voices, all to help our audience make sense of a rapidly changing world. Looking back at when Street Signals first launched, what was your original ambition for the podcast? And how has that vision evolved as markets have shifted into a world defined by higher rates and greater political uncertainty? Let's start there.
Cool. Yeah, no, I don't know if the vision has really evolved that much because of market conditions. The content, of course, has certainly changed. But I remember very, very clearly when I got the idea for the podcast. It actually, you say it's the third birthday of the podcast, which is true. It's been public for 3 years, but I've been doing it since 2019. The first 4 years, we could only do it for clients, and we kept it on our internal website. But I remember coming up with the original idea. It was one of those ideas literally in the middle of the night, it came to me to think about this as a really good way of delivering our unique research content to a wider audience. That was the vision. Look, I have an ego. There's a bit of personal branding here. I've done a lot of panel hosting. I did one at our research conference yesterday. So I thought, okay, this is also a good thing for me potentially. And podcasting at the time, this was pre-pandemic when I came up with the idea. After the pandemic, everybody has a podcast now. There's probably too many people with podcasts. But prior to the pandemic, it was a way that people were really starting to consume information. And I kind of thought, well, let's marry all of those ambitions. And that really was the ambition, was to deliver research content, to speak to external guests as kind of a backdoor way. This is a way I've been able to get to meet some of the people who I really admire in this business, and to have an outlet by which I could reach out to them and get to know them a little bit. That was really the vision, was presenting market commentary as well. There's a lot of our competitors who do this and just kind of present their research, and it's just a repetition of a research piece. But really, it's wanting it to be markets focused. And as I say, it hasn't really changed. I never want it to be, of course, a sales pitch. I just want it to be something that's thought-provoking. And as you mentioned, some of the things that have changed in those 7 years have made the content different. But the vision, I think, is still that, a markets-oriented podcast that is very accessible to not just the practitioner, but the layperson.
Well, first I want to say, I think you are very, very good at it.
Thanks.
In my mind, I think the key, in addition to having phenomenal guests, the key value added is the dialogue.
Yeah.
It's through the evolution of the dialogue, which has become so important in this world of uncertainty, because we all don't have the answers. So the dialogue is what you're facilitating, is enabling us to think a little bit deeper and somewhat differently and try to figure out what is going on. But let's go back to the macro backdrop. That has
Mm,
changed dramatically,
yeah.
right? It has gone from somewhat of a low rate stability to a volatile regime. What, how has that shift influenced the way you frame conversations and importantly, select topics for
Yeah.
the podcast?
The two things that really come to mind that I underappreciated are the two big topics, which, as you mentioned, things have changed that have forced me to spend more time on. The first one is geopolitics. I suspect we'll talk a lot about geopolitics and geopolitical fragmentation. One of the very first episodes I did publicly, so this would now be about just under 3 years ago, was we have an academic partner called GeoQuant, and they sort of try and quantify geopolitical risk. And that was the first episode where the audience really grew. And it grew because it was not just interesting branded content, but it was more relevant than I really kind of appreciated at the time. We all think geopolitics is important. That really kind of that's where it hit home from me. And I actually think this is still evolving and changing, and it's changing the way I approach the podcast in that everybody now talks about geopolitics. Everybody has an opinion on it. And I think it's almost getting to the point where you still want to do it. It is just one of those areas where it is now saturated, but that's how the podcast keeps evolving, I think. Inflation is probably the other big topic. We have our partnership with Price Stats, which regular listeners to this will hear a lot about. And I have Alberto, our partner there, but also I bring it up most episodes when we're talking about the macro environment. And so in terms of how the framing of conversations has changed, it is this stickier inflation, rates higher for longer type of dynamic that features very, very heavily, more so than I maybe appreciated at the beginning. And it always gets a really good response. Those Price Stats episodes that I get, 30, 40 minutes with Alberto, they're always some of the best listened to. And I think the final thing that has changed is just over the course of not just the 3 years, but the 7 years is I'm not a person who buys in. Doom and gloom gets clicks. I'm not a person who strives for that. I really want to get diverse perspectives. I have a lot of time for being pessimistic and tactically pessimistic, especially. But as a kind of big picture principle, I view many of the problems in the world, the investing world especially, as solvable. Market returns don't go up in a straight line. They do tend to be positive, though. And that's thanks to, some policy biases that central banks and treasury officials can be guilty of. But nevertheless, I don't want to go out and grab audience by just being negative and going for clicks. Even if that means the audience is smaller, I've kind of made the conscious decision over the years to approach it that way and to present guests who actually present things in very constructive and realistic ways.
You mentioned this idea of saturation. And in fact, I think the approach that you just outlined would be the one that would down the road turn out to be more useful than trying to go for clicks, because you're looking at ways in which you can practically solve problems. So that leads me to the next one.
Mm,
For the last 3 years of hosting this program, our goal in State Street, as you well know, is in trying to translate complex macro dynamics into actions in either in rates or effects or credit in a number of different commodity markets, right? So, how, given the change that we have seen, the markets have injected a ton of humility for all of us. So, how has your approach changed into ways in which we can translate what you're hearing from our guests into clear, actionable insights?
yeah. I don't know if my approach has necessarily changed. My big philosophy is I'm just trying to be less wrong about things, about anything that I think about. And that was a challenge before this podcast existed. It's one that I will probably have until I retire and long after that. The main thing I think that has changed, there's two things that come to mind. Market drivers, as you alluded to, and macro dynamics have definitely changed. And I think the biggest way they've changed, when I started as a strategist doing this 20 years ago, and even in the 5, 6 years I worked in like sales and trading before that, fundamentals mattered a lot. You had really reliable relationships, especially in FX markets, that you could really kind of bank on in terms of following as a trend, or following mean reversion strategies or dislocations that would happen, a correlation between two variables that you could play. And it was pretty reliable. Now you have markets that are very narrative driven. You have one or two themes, and everything just kind of fluctuates off the back of that. And the market's attention span kind of moves on very quickly from those themes. So the approach I take with the show is trying to figure out, okay, what themes are ongoing that are maybe about to die out and then I don't need to spend as much time on, or what is maybe around the corner and what should I start to focus on? And that's how my approach probably has changed, is trying to think about that. And I often get it wrong, but there have been a few instances where I've gotten it right and the message kind of clicks. Not that I've ever gone viral or anything like that, but the message really clicks and it gets good traction. And that's really satisfying. The final thing is I'd underscore, and this is not, this isn't a sales plug necessarily, but I think behavior and emotion and understanding behavioral finance, which is something we strive to do, I think that's become a lot more important simply because as a byproduct of that discussion of fundamentals. Fundamentals do matter, but emotion and sentiment, I think, are what actually drive markets more so these days than previously. And so, I've had to change the way I kind of think about things and do the show as a result.
I think you hit on this important shift that we have seen, how the emotions have started to become a bigger part of a driver of markets. We've had some discussion in our macro meetings where we have talked about historically the negative correlation between changes in gold prices and real rates. But that shifted, and that's a shift that we have seen recently
Yeah.
due to things that we never thought would unfold. So there's this question of how do you balance conviction with a sense of humility?
Hmm.
And the example that I just gave you was one of those. I remember being in a meeting where the theory tells you it's negatively correlated,
Yeah.
but then the markets have shifted. So you have to be humble to say, well, something has happened here. So how do you balance conviction with humility when you're discussing markets in real time?
Well, my long gold position in my PA is making me very humble right now because it looks like those drivers are changing again. Look, when it comes to conviction versus humility, the working premise I have with everything I do is that I know absolutely nothing. That's not really just a byproduct of the show. It's how I approach things. And I also think it's also the guest's perspective, and I think, look, when it comes to my opinion, especially on the podcast, if you're hearing my opinion, something has gone wrong. I'm kind of there to not put my views forward. I'm here, and I'm doing this to get their views out and to get their thinking out in the world. And I think it's important for the context of the podcast to think about how they make that balance, which I think most of them have that. I wouldn't say low conviction. Maybe I've talked to some guys who are kind of short-term traders who see dislocations. They don't make sense. They have a quick opportunity to look for those gaps to close. But you know what? They'll always have a stop on those trades, right? Like that, even high conviction views, you have to account for the possibility that you're wrong. But for those focused on the long term, I think we all kind of appreciate, both guest and host, that they're going to often, and I will often be wrong. And important things like entry points, exit points, you're sizing your views right. And that's the more important step to get right than rather than trying to have, this hit ratio that is more than 60%, which, if you're doing that, you probably aren't talking to me. You probably don't need to. You're probably retired. The other part that I try and do to have some humility within the discussions is I do a lot less preparation than I used to, mostly because I'm very, very lazy, but also I would often go into conversations thinking, well, this is going to go this way. And then it went another way. I don't have a monopoly on understanding how people think, thankfully. And it's always gratifying to get surprised when you do an episode. That's the best part, really, for me, and to take it in a direction that I wasn't really expecting. But that requires the humility to understand that people's viewpoints are as fluid as I hope mine are. And we all need to adapt. We need to kind of rip up preconceived notions that we have. And I think that's really healthy. And that's what I kind of try and bring. And I bring that ironically through kind of a lack of preparation, or at least I guess the better way, more fanciful way of putting it is I'm more open-minded, I suspect, as a consequence of that.
Well, that's sort of one of the key strengths of the show, to be open-minded, to have an intellectually honest dialogue with the guests, right? And you had a number of them. You've had external voices like Mark Dow, Claudia Somm, and Brad Setzer. And I've been in some of in conferences, as you know, with many of these people, and you also brought our own CEO, Ron O'Hanley, along with our internal colleagues. So you had a combination of both internal as well as external now. Can you talk a bit about some general themes or perspectives that these external voices brought relative to our internal colleagues?
Yeah, I think it's the specialist versus generalist element. We are, as a strategy team, we have specialities. You mentioned mine. I look at vol a lot. I look at G10 rates and FX, but I also look at everything. My Bloomberg Launchpad screen is pretty much every asset market you could look at, because I think they all inform each other. And so for external guests, they are often usually quite specialist. And also, again, going back to the previous answer I was giving, they can, I think, bring the element of surprise a bit more. With internal guests, I'm often talking to them, and you and I have talked about work that you've done, and I've read it. I think it's interesting. I can bring that to a bigger audience as well. With those cases, I kind of have an idea of what we're going to talk about. I have an idea of what you're going to say, because I've done the prep work, and really it is a little bit of wanting to put the things that make State Street unique, putting them front and center. And I don't, again, I don't want it to ever be too salesy, but that is really, I'm not doing my job if I'm not doing that. That's kind of the point of having this podcast in the form that it's in, and having it being sponsored by the company. And I'm not really doing my job if I don't know what the messages and the house view are, and if I'm not bringing that to light to the broader world. That happens with external guests as well, and I kind of often know where things are going. But as I say, I love to be surprised, and I like when we get away. The best ones are where we get away from the things that I've kind of prepared to talk about. I like asking why. I don't really do that often enough. But when you have an external guest on and they're a specialist, they're always going to be better at telling you why. Claudia Sahm, you mentioned, she will always have a better formed understanding of the US economy than me, or probably anybody else on our team. Let's be honest. Brad Setzer, he will talk about capital and current account flows in a much more coherent way than anyone on our team, because that is literally what he does, 18 hours a day, 7 days a week. Really, he's just much more focused, which is what you want, I think, really, for a podcast.
The market is a great teacher and makes us all very humble. And I think it's become more so in recent times. And bringing in experts who look at particular areas. This great list of guests that you've had, including our own CEO, Ron O'Hanley, Brent Donnelly, Martin Gurry, and Brad and others. Was there any particular guest that you felt had an impact on the show itself, and perhaps how you think about markets today?
Yeah, I mean, all the ones you just mentioned certainly did. I mean, Martin Gurry is probably one of the 5 most interesting people I've ever met. So he certainly had an impact. For those who don't know, we did this episode, I think it was about 2 years ago now. He worked at CIA during the explosion of the internet in the late 90s, early 2000s. He studied how information and data explosions happened, what effects that took on, social stability, really. He has a book called The Revolt of the Public. It was written just before the 2016 election, I think in 2015. It presaged populist politics. It's still the best book, I think, on populist politics and social media. And he's also, his perspective was really good. He immigrated to the US from Cuba at the time of the Cuban Revolution when he was a very small boy. And he has this perspective on what makes America the great country that it is. And I take from him, and I read him often to get a really good grounding, especially as the son of immigrants myself. You can forget what makes the country great. And you read someone like him, and he has his finger on the pulse of that. And so that really impacted me in how I look at the world. Brent Donnelly, you mentioned, the impact he had was in growing the audience. I mean, he took it for what was from a kind of a decent sized audience to what was basically on another level. And he put it there permanently. The episode I did with Ron also did that as well. But Brent himself was one of the first ones. He has like tens of thousands of followers on Twitter. They follow everything he does, which I do as well. So, his impact, and we can maybe talk a little bit more about the content in a bit, but his impact really was on helping to build the audience. He's a super nice guy who was really happy to help out at a very early stage of the podcast. And I remember when he posted or reposted our social media on his Twitter feed, I just sat there refreshing my phone for like 3 or 4 hours, watching the numbers go up and thinking, okay, this is actually going to be maybe bigger than I'd hoped. Ron had an impact actually. The very first episode he did was a couple of years ago, and people who watch the firm and follow the firm have to pay attention to what he says. And the first one we did had some really, what I thought at the time was really interesting content, because we had just had the US election in 2024. We didn't know, but we were about to have the Liberation Day event. We knew tariffs of some sort were coming. And before all of that, he had a really good take on things, which was that yes, trade protectionism, tariffs are coming. That is a thing, but that it wouldn't potentially be at a scale that would be a disaster. And look, for a few weeks, that looked really wrong. But implicitly, I think underpinning that, what he was really, and I'm not trying to kind of think for him, but I think he was kind of getting at the whole taco trade before people really started to talk about it in that way, in that he recognized that, yes, this is coming, but there is a political and a practical element to the things that Trump is saying versus what he will actually do. And so that had an impact, I think, as well, as being kind of ahead of the curve and thinking about things in a very practical and realistic way.
So one of the things you've done is to have a consistency with the recurring contributors like Albert Caballo and Elliot Henta, who are both colleagues of ours. And you've been able to revisit some themes both on inflation and geopolitics over time. In having the same guests come back and discuss comparable topics, sometimes the same topics, our understanding of the underlying topic also shifts, right? With the macro dynamics changing. So, how has your understanding of inflation persistence and geopolitical risk evolved through these repeat conversations?
Yeah. Yeah. So Alberto's work kind of speaks for itself, right? When you are a co-founder of a small business that's focused on alternative data, and Jay Powell cites you as helping the Federal Reserve through, a period when official inflation data isn't available because of the government shutdown, you are probably a guy who is worth listening to. Of course, he's helped me to understand and evolve my thinking on inflation and how price shocks travel, especially. We've had two energy shocks, we've had supply chain shocks, we've had tariffs, all just in the last 6-7 years. And Alberto, of course, helps to provide real-time data on that and to get you a sense of how inflation forms. How does the process work? But it's actually the supply chain dynamics that I think he has started to really help me understand, because I didn't really focus on things like that before, where inflation shows up in the supply chain. And he's taught that to me as much as how the inflationary process forms and persists. And Craig Fuller actually is another guest I've had on. He's from a company called FreightWaves, another alternative data provider. He focuses on shipping and logistics. It's very similar, all supply chain type stuff. Like Alberto, he's very passionate about it. He makes you want to read books about stuff like trucking and stuff that people in our world just don't take as much time to think about. And so both of them have really helped, I think, on that inflationary front. Elliot's, for me, is really interesting because he's another one of these guys who I often try to predict what Elliot is going to say ahead of him saying it. And he almost never, I can almost never do it, because he as well, he's very adaptable in his thinking. He knows his body of work cold as well as anybody in the world. And he's also a very good reality check when sentiment starts to fly too far in one direction. And I'll give you a very concrete example that sticks out in my mind. When the events of October 7th, I think it was now 2023, when that happened, I had him on not long after that. And it was a very raw period, very difficult to think around, because you think something has changed in the world, and ultimately it definitely did. But he took this
Yes.
approach to geopolitics that I think has stuck with me ever since. And it's kind of why I poo-poo geopolitics a little bit now, which, geopolitics for markets really matters across three lines: what it means for sentiment, what it means for trade flows, and what it means for capital flows. And as much as people tried to make something of it, really, he pointed out, trade and capital flows are not going to be affected at all. These are small economies. In the short run, there'll be a sentiment impact, of course. And it's an important situation. The last thing I want to do is downplay that, especially now we have what is a truly uncertain situation in the Middle East. And we are seeing long-term impacts. But the takeaway is just that the economic impacts, step back and consider those first, but also consider that things might not work out according to your time horizon. If you tried to buy oil, say, off of the back of that event, you wouldn't have
Right.
done very well. And he has brought to me the perspective that geopolitics matters, but it matters and can matter in deceiving ways. Benoit Mandelbrot has these 10 heresies of finance, and one of my favorites is that time is flexible. You might think the short run is when all the news gets priced in, and maybe you're right about that. But Elliot's quite good at thinking about markets are complex. They have too many moving parts, and to say geopolitical event A automatically leads to market outcome B doesn't consider that complexity, I don't think.
I fully agree with the notion that is very flexible and dynamic and fluid in his thinking, which is really important in these markets. Now I'm going to ask you,
Mm.
Tim, to put on your macro hat and not just focus on the show, but tell our audience a little bit about how you see the world. In the sense that when you started the show, and this is interesting, when you started the show, the world looked very, very different. In fact, at the beginning of this year, as you well know, the markets priced in between 2 and 3 cuts in rates in the US. Now we are talking about potential hikes. So it does look like this idea of having an equilibrium of 2% and landing this massive plane at 2% and trying to find ways in which we can go back to that world is getting questioned. And geopolitical instability is taking multiple forms that is hard to forecast. Now, as a macro thinker, I'd like for us to hear from you. How
Mhm.
should investors be thinking about these forces today?
Yeah. But I've kind of answered the geopolitical instability one a little bit. To sum it up, I think geopolitics is becoming one of the more overrated factors to spend time on. It's not unimportant, as we've talked about, but a lot of people have become experts on it. And again, unless it's really impactful for trade and capital flows, it's probably not as market moving as one might appreciate. The higher for longer rates question is one that I think is going to potentially live with us a little bit longer. Insofar as I'm less my prior on inflation as a topic has been throughout my career as a sort of disinflationist, where technology especially improves productivity and overall leads to a fairly stable inflation environment. And obviously that has been challenged. And I don't know if I'm necessarily ready to give up on that perspective, but I have to question it more because I'm less certain about how policymakers will react and whether rates will remain higher for longer, or if we do need to ultimately reprice inflation expectations on a kind of to use a phrase that was unfortunate when it was first used back in the 20s, a permanently higher plateau.
Mm.
I think we probably do have to account that for that possibility, simply because the mixture of especially fiscal policy is such that I don't see anyone on the treasury or finance side of an economy really willing to rein that back in. And nor do I see as powerful a monetary response as might be required to rein any inflationary pressure from fiscal policy in. So really, I don't believe central bank independence has weakened that much. I'm not a big doom and gloomer on that. But I do think it is a reality that we have to live with, and that I think about from my own personal standpoint is, do I want duration as making up a big portion of my portfolio, where whether it's a 60/40 or, you kind of have your kind of levered fixed income views and risk parity as a means by which you protect returns. I really don't think we can take that for granted. And the macro implications that then come out of that are, well, okay, you want to probably be long of the currencies that you see central banks who are willing to address these pressures, and stay away from those who aren't. But that's also very unclear because, as you say, it's very fluid. We've gone from a Fed easing policy as the expectation this year to one where they are expected to hike policy, despite the fact that the new central bank governor is coming in ostensibly with a mandate to ease policy. So that's where I think volatility is underpriced. I think the potential for higher for longer rates is a bit underpriced. And there will be positive surprises on this. I'm quite certain, we have an ECB meeting today, actually, as we've been speaking. I don't even know what they did, but I'm guessing they hiked rates. They're starting to be a bit responsible about this, where I don't know if every central bank will be as responsible.
Couple of other things that have come in our conversations, both in our macro meetings and with clients, is this idea of potential disintermediation of banks from digitization. And the other one is, of course, the impact of AI. There's AI everywhere, right? Both of these are somewhat in early stages, as we both know. AI being something that's endemic to practically every single conversation.
Yeah.
What's your thought on these two important forces unfolding?
I'll be honest, I don't, on the former, the bank question, I don't have a lot of coherent, complete thoughts, certainly not ones worth listening to. But I certainly have thoughts on AI. And I think we are in the midst of figuring out the cost side of AI. We've been pricing markets to focus on the benefits. And I think when we see what some of the LLM providers are starting to do with what they're charging their customers, we're starting to enter this period, I think, where, look, AI, as a disinflationist long term, I suspect there will be productivity gains and it will lower cost, and the capex that's going into this will be productive investment. But in the short run, I really don't think that's the case. I think it is very, very inflationary, and people are going to get a big rude awakening. I think corporations have purposefully held off from hiring in the hopes that AI can be used to transform businesses. And again, long term, I'm quite confident that will be the case. But corporates who have gone from sending you emails saying, please use AI and try to make your job more efficient and try and achieve cost savings, et cetera, et cetera. I think a lot of them, once they start looking at what token costs are going to start sending emails metering the use and saying, please don't do this. Actually, maybe let's think about this a little bit differently. And I think a lot of the hopes that capital was going to replace labor might be at least postponed or sidelined in the fact that capital is maybe going to get quite expensive when it comes to the use of this. And I think that has a lot of important implications, of course, for investing.
That point is very well made, particularly with the rates potentially staying higher. I did want to ask you, you're sitting in London and I'm here in New York. Over the last few years, mm, one thing that's been central to the markets is this idea of US centricity and US exceptionalism. That's defined the hegemonic role of the US dollar. That's made, given the treasuries being the most liquid and the deepest market, made that the primary market. Now, we see there's some shift happening. I've seen this in my conversations. You've seen this in your conversations. You're more so sitting outside the US. How do you think that particular sentiment, narrative, and feeling likely to shift markets in the next few years? It seems something that's somewhat underappreciated, but it's so central to the markets. I'd like to get your thoughts on that.
Yeah, I think it's natural to think that there is a loss of US centricity simply because the US has been more central than it probably warranted. And it is the exorbitant privilege, I think, that was alluded to when it comes to the US dollar as the dominant reserve currency. The US has, until recently, been the country that is willing to absorb demand deficits from the rest of the world.
Yep.
This is why you have Trump, I think. And it's reached a natural tipping point where you saw, and as someone who grew up in the Rust Belt of Northeast Ohio, saw industrial jobs leaving the country as far back as the 1970s and into the 80s. And then you saw it continue into the 90s with NAFTA. And we're at the natural tipping point, I think, or an inflection point. We have reached the point where the politics of this are not that, all these benefits to free trade will trickle down. And the human cost of that, I think, has meant that we need to, or the demand is to be, or the US is no longer the source of demand for the rest of the world. And I think that's ultimately what this is all about. And that that drives the dollar's use as an invoicing currency. The share of dollar is dollars in reserves because, of course, the US is the primary issuer of the reserve currency. And as a consequence, ease of transactions means it's easy to use the dollar. And so I look at it as a reality that is probably not as unhealthy or should have as unhealthy connotations as it does. Because I think it all stems from some of the factors that I was discussing. The upside of Trump is pointing out that contradiction, right? Like seeing that is a unsustainable path for all of these countries, I think is a really important realization. And reversing that even in small part is probably not the most unhealthy thing to happen. In fact, when you look at, I don't believe that there is de-dollarization really. When you look at the US's role in trade, I should say, it's still well
Yeah.
below the use of the dollar as a trading and invoicing currency. It's like, it's multiples higher than what the US actually
Right.
contributes in trade. So rebalancing that somewhat as part of a broader rebalancing of capital and current accounts, I think is a natural kind of resistance to a relationship that had been squeezed too far or pushed too far.
As I was listening to you, I was remembering the interview given by Lawrence Wong, the Prime Minister of Singapore in the
Mm.
FT, basically said that the US has stopped being the global insurer of the world. The rules of the game have changed. The old rules don't apply, and the new rules have not been written yet.
Mm.
So there's a little bit of that unfolding as in the world today, and this particular podcast with the great set of guests that you have really helps us understand this complex set of new rules that we don't know and not been written yet, as the world, as you said, is sitting on a pivot. Let me try to close with this. Of all the conversations over the last 3 years, what was the most formative personally and why?
Yeah, there's two that stand out. As I said at the beginning, one of the main reasons I started this thing was to try and meet and talk to people who I admire in terms of the way they think. I'm happy to say that I've actually crossed off most of my bucket list on that. And the top of the bucket list actually was a guy named Mark Dow. And I don't know him, I didn't know him personally. He's a market thinker and a guy who writes on markets, and he's on Twitter all the time. And I followed him for years and always just loved what he had to say. And I basically cold called him on Twitter, and he's now been on twice. And each time I have to say it's been one of my favorite kind of 5 or 10 episodes.
Mm.
He's a super nice guy. The first one I think was formative for me personally because it proved that, and this was like 6 months in to the public release of the podcast, it proved to myself that I could kind of stick my neck out. I'm naturally very introverted. It might surprise people to hear. It's very difficult for me to reach out to someone I don't know and then to have a conversation with them, and to have a conversation with someone who I admire, who is clearly more experienced, more gifted at this business than I can ever hope to be. And so for the first one, I kind of teed him up. He has great thinking around central banks, and he puts things at a level of understanding that I think is probably the best in our industry. And I really wanted more people to hear that from him because I think it's such an important message, because he challenges a lot of the really lazy kind of garbage that's written about central banks and how nefarious they are. And
Right.
topics like quantitative easing are probably some of the most misunderstood. And he just puts it in a really nice perspective. And especially also on markets, he's like us in a bit. He thinks about the world of behavioral finance and
Yeah.
understanding that emotions drive markets as much as fundamentals. And so, his insights have saved me from myself, I think, a lot of times. And he's just a super kind guy. He has no ego. He's very generous with his time. And I've followed him for years. So that was kind of the first one where I was like, yes, I can do this. The second one is a guy named David Dredge, who I had
Mm.
on last year, which was probably as much, if not more formative for my own kind of personal investing. As I mentioned before, I come from a derivatives background. Dave is a
Yeah.
vol guy. He is sort of a long vol guy. He has his own sort of long vol / tail risk type of hedge fund. And I had this set of expectations before I talked to him and I thought, oh, maybe this is going to go into like permabear territory, which I can't really stand. But it actually, his framework could not be further from that. Like, yes, he looks for opportunities to buy cheap vol in his fund, That is to protect against, left tail events. But I think I should be clear, not his left tail events. His fund is all about providing insurance to asset
Ah,
owners who just want to take a ton of risk. He
yeah,
wants people, his whole thing is take a ton of risk, but have a
right.
hedge. And the
Yes.
analogy he used was he likened it to the brakes on a race car. And that
Yeah,
analogy has stayed with me. And his message is
yeah,
like, take tons of risk, but buffer
yeah.
it for something. When you're in that race car, you're on the straightaway, you're heading into the turn, you need good brakes because otherwise you're going to go straight into the wall and your compounding path will get destroyed. And so I'm basically a huge disciple of that philosophy now. So that has been very, very impactful for me.
We all come into this world with these conversations with a set of biases and preconceived ideas about either economics or how the markets behave. We need ways in which we can save us from ourselves. And these conversations greatly help in doing that. Tim, this has been a tremendous amount of pleasure to be on the other side, to put you in the hot seat now. I've really, truly enjoyed this conversation. A little biased here, being your colleague. You bring tremendous amount of value and insight to our listeners, to our to our clients and prospects. Tim, it's great. It's been terrific. Thank you for your time today. Congratulations on the 3-year anniversary. And I look forward to continued success on Street Signals. Thank you
Awesome.
for being a guest on the program.
Thank you so much, Rama. We will definitely have to do one with you very, very soon. I'll put it on the schedule. Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. State Street Bank & Trust Company, hereafter referred to as State Street, and is for informational purposes only, and is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.